Sandip Agarwal is now with us, fund manager at Sowilo Investment Managers. Sandip, good to have you with us here. Good to have you back on the program. Prashant here. What's your sense, Sandip? The numbers that you've seen so far, the commentary seems a little bit more grim, optimistic. I mean, it kind of sort of ties in with what your view has been for a while.
Yeah, hi, good morning, Prashant. And if you see the numbers, they were really, not what we have anticipated and the street was expecting. So lower numbers. Unfortunately, the bigger problem is that, margin guidance have been brought down. Now, if margin guidance is brought down by TCS by 1%, the impact on EPS is 4-5%. But if it is brought down by HCL Tech, the impact is 7%, 6 to 7%. So that is the biggest challenge. And, it clearly reflects what we have been saying for quite some time now, that this is a mature industry for large caps to grow beyond 5-6% on a steady state basis with slight improvement in EPS due to buyback. I don't expect beyond that anything on that. And to that extent, all the stocks are very highly priced in the large cap, mid cap and small cap. While growth in mid cap is 2-3% higher and small cap is 4-5% higher, but the PEG ratios are even much higher. So I think the sector is very mature, primarily because outsourcing has peaked out to a large extent in the major market, that is US. Now the incremental outsourcing is very, very low. We are at 96% market share already. I think, this industry is now mature for growth. I don't see big growth coming in next 4-5 years at least.
4-5 years, grim, unless the models change. Sandip, hi. So, HCL Tech is speaking about some sort of a restructuring. Now, we don't have too many details, but I think they're basically saying that it's aimed at bringing margins eventually back to above 18%. They look at better utilization of their facilities outside India, etc. How do you view this exercise? I mean, and they're also talking about Gen AI costs, etc., upskilling. I mean, basically, my question is, how do you rate these large IT services companies' attempts at trying to remodel to capture more of this Gen AI opportunity?
So I will tell you that, last 30 years, I've seen many disruption, but nothing like Gen AI and agentic AI. This is complete disruption of the business model because efforts are going down so much. I will tell you our own personal experience. Our efforts within the organization with use of Gen AI has gone down by 70-75%. Now, if that is the pace at which we, a small firm, are able to reduce the efforts, you can imagine what kind of effort reduction would have happened. Now, what is happening right now, because of that, the bench strength or default bench strength or the utilization is showing up in numbers which is lower. What companies will do, in my view, next 2-3 quarters, they will start recruiting lesser and lesser number of people. They will try to first use the bench. So some improvement in margin will show up, but growth will not come because efforts are substantially going down because of use of this newer technology, which has not happened in the past disruption. So this disruption is really killing the efforts which are going into the system.
Do you have an estimate? I know this is tough to gauge at such a wide global level, Sandip, but you gave us an example that for your firm, the effort required is down by 70%. I mean, just in terms of sheer manpower because of Gen AI. So what is the cutback that we are perhaps going to see over the course of this year and maybe even next year in just the requirement for bread and butter type of IT services?
So I think the volume will substantially go down every year. So the growth which we were getting earlier, 7-8% kind of growth and volume or efforts, I think that growth will be muted to 4-5%. Remember, it will be a slow process because, the technology itself is evolving. So as you get the new client, new requirement, which is generally 1-2% of total budget. So it takes 4 to 5 years to, see the whole impact. But in my view, that's the reason I'm saying 4-5 years, you will see 5-6% growth in best case scenario for the large names. Beyond that, I will be very positively surprised unless, these companies are able to reinvent and, bring in some platform revenues and some massive change and restructuring in the whole business model. Otherwise, 5-6% effort growth will be a very, very good effort growth in my view.
All right. Hi, Sandip. Good morning. Good to hear your thoughts. Sounding a little bit cautious, though, and a little disappointed with the numbers that you've seen so far. I wanted to ask you particularly about, not the large IT companies, but the more mid-sized, like a Tata Tech, or a Tata Elxsi. Now, some have been saying, in the last 3 years, you made no returns on big tech. But if you bought these companies, then you're actually down 35-40% as well. But still, the numbers not very, very impressive. What do you make of these stocks? Is it providing you an opportunity? Because once growth picks up, then these guys will outperform on the growth side. But in the near term, there is a lot of uncertainty.
Yeah, hi, Nigel. It's a very good question. So if you see the ER&D space and the non-traditional IT services space, they are going to grow at least 4-5% higher than the traditional IT services, which is the space where, some of the mid caps and small caps are operating. There is some challenge in Europe, auto, and some places there are some problems. Because of that, these companies are struggling. But the question is that, even if, let's say, these companies are able to grow at 11-12% for next 4-5 years, on revenue terms, the margins cannot go up substantially because they are doing good margins and the wage cost hike is real. So in that case, if you are giving them 40-45 multiple, I think that is too much stress. So in my view, the problem is that where there is growth, the multiples are very demanding. And where there is low growth, there also multiples are demanding. The only rationale which I see today, even when we manage our PMS internally, is that, we will replace some of the FMCG stocks with technology stocks because the growth numbers are similar, but the multiples are 30-40% cheaper than FMCG. So I see only that rationale to buy technology today in my fund. Other than that, there is no fundamental rationale to buy these stocks, even after time correction, price correction, which has happened.
Guys, you should listen to this
Says it as he feels it. Sorry.
The Anthropic CEO, who was earlier with OpenAI, his interview on CNN, this is, I think, about 10-15 days back, just absolutely, because, everything is coming from there. We are kind of sort of reacting to it from the US, essentially, from 3 or 4 large companies, right?
Yeah.
So, I don't know if you wanted to scare everyone, but that's...
I think Sandip's also done a good job of that. He's sounding very dire, but I guess it's that level of disruption that we see.
That's what he believes, but I know Sandip has strong views on this as well, but we'll get him back and we continue to chat with him about this. Thanks very much, Sandip. Great to have you with us here. Appreciate your time here on CNBC TV18. What we'll do is take a quick commercial break here.